Hey, good morning, investors. I'm Stuart Cruz, founder of Cruz Asset Management. It is May 6th, and we decided to make a video because the Fed just raised the federal funds rate by 50 basis points yesterday, or 2 days ago, excuse me, and the market rallied by 900 points because Powell said that they weren't going to raise 75 basis points, or they weren't considering raising it 75 basis points in the next meeting. And the market had a huge rally, and then the following day, yesterday, dropped by 1,300 points. So what's going on here? Well, and more importantly, what's going to happen in the future? Well, let's just go to some of these charts here, and I'm going to bring up let's just start with the market itself. Okay, right now we have, from our friends at White Charts, the month of April. So we have the S&P, the Dow Jones, and the NASDAQ. And from the month of April, the Dow Jones was down 5.3%, the S&P was down a little over 9%, and the NASDAQ was down 13.5%. These are the worst monthly down swings since 2008. So we're in the thick of it. It's pretty bad. And if we go to a year-to-date chart, things don't look any better because the first quarter we were all down. So here the Dow is down close to 10, S&P is down almost 14, and the NASDAQ is definitely in correction territory, which we've seen. Now, I know a lot of you people holding on to the tech stocks are saying, hey, are these companies coming back? They're at a value spot right now. I've got to buy right now. Obviously, look how low they are, but you're looking from an anchor point, and this is one of the biases that people fall prey to all the time. If I don't know, Amazon was at an anchor point, then you say, hey, it's much cheaper than it was. But the fact of the matter is things can always get cheaper. What happens is generally when markets are overvalued, which they were trading at a PE of, call it 22, a forward PE in the S&P of over 22, where the long-term averages are in the 16s, 15, 16 range. Often when you have a breakdown, you don't go down and stop at fair value, and we're not even there yet. You usually go through fair value to cheap, to the other side. Now, I'm not going to say we're going to go down to the 2008 levels where the S&P was trading at single-digit PE ratios, but we could certainly go down to a PE below 15, and we're still in the 16, 17 range, still in the upper end of the range, so that we have some weakness to kind of work out. Let's look at a little bit more here. So right now we have the Dow Jones, the S&P, and the NASDAQ up here. If I add some other indicators, here our bonds came in at green. That's also down 10% year to date. Here's the international. This is way down 13%. Here are REITs, which are also down. Let me add my REITs, down almost 13%. And you're saying, hey, in a market where you're supposed to be diversifying, there's no benefit from diversification. And that's actually true right now. Some of the correlations are going higher. There's no real good pockets of places to hide. But that's actually, on first glance, looks true because all the major asset classes are down. But at Cruz Asset Management, what we were using were technical indicators of momentum, things that tend to work over time. And as momentum trends down, it tends to continue on that path. And so we were lightening up on equities back in January. So we did not even nearly fully participate in the worst month that we've had in the last 14 years through April. So a lot of our accounts, while they are still slightly negative, they certainly are not seeing this kind of decimation that you see in the marketplace. But that doesn't really kind of go back to where do we hide. Now, if I take and clean up this chart a little bit and I take some of these layers off so you can read this, and let's just keep the S&P 500 here for a reference point, that's down 14%. There are areas in the market that are doing well, like commodities. And there were signs to get into commodities months ago, in fact, almost a year ago. So you can take sector bets, which we have taken sector bets on, let's say energy, which is also up. So there are bull markets in investable landscapes. Okay, it's just not the S&P, and unfortunately, it's just not technology. And think about this: in general, technology is leading the way down. Almost never does that same sector lead the way back out of into recovery. So it's our personal opinion that technology is going to remain weak for quite some time. And why is that? Well, in a lot of these tech companies, they were trading at very, very high PEs. And what is a PE? It's price to earnings. So you have a price divided by the earnings. It's a ratio to basically indicate how much are you willing to pay for a dollar of earnings for a particular company. Now, oftentimes some of these companies weren't making money, so they had no earnings, so there was no PE. Or you're willing to pay up for a PE or a dollar of earnings because you think there's going to be a lot of future growth. So if you're willing to pay a company $50, have a PE of 50, that means for every dollar they make, you're willing to pay $50. That means if they keep making a dollar every year, you get paid back in 50 years. Now, you're not going to sit around and wait for 50 years, so you're hoping they're going to grow into this earnings, then maybe they make a dollar this year and $2 next and $4 the year after that. So you're willing to pay up. The problem is, if you have low interest rates at zero, which we had for a very long time, there is no discounting those future dollars. Every dollar 10 years from now is roughly worth the same amount of dollars it is today. But, and we made videos about this 3 and 6 months ago, when you get rising interest rates, which we assume were going to happen given the large amount of stimulus due to the COVID lockdown, when you get rising interest rates and rising inflation, so let's just switch the chart to an inflation number. Here are inflation numbers over the last, call it 30 years, just a little under 30 years. If we want to, matter of fact, let's put in an average inflation number. I'll do this on the fly. What's our average line? We'll apply that. Average was 2.33. So we had some high levels here, some low levels here, actually deflation back in 2008. And that's what Bernanke was afraid of, that we were going to get deflationary pressure. So we actually used a lot of economic stimulus to combat deflation. And now we have a print that's higher than that's been in 40 years. So when you have high levels of inflation, now the dollar tomorrow is worth 91 cents, 91 and a half cents, or dollar next year is worth 91 cents. And no longer is it worth basically that same dollar. And in 10 years, it's worth half of that. So when you look at the money that you're going to be making in the future, no longer can you afford to wait those 50 years. So you get what's called multiple compression. And so all these tech stocks that got ramped up where the PE ratios were higher over time, like let's say Apple traded from a PE between 12 and 18 for about 10 years, and then it went up to a PE of 45. Not because it was growing any faster, but just interest rates were going and there's no other place to put your money. So to see Apple's PE compress, and maybe we can also do this one on the fly, I will bring up a chart of Apple here. Hopefully this kind of propagates pretty fast. Here's our chart of Apple. It's kind of a maximum chart. Let's kind of look at the last 10 years of Apple. And we are going to put on a PE ratio. We're going to split this out, and you can see down here, I'm going to take price off here, and I'm going to look at this PE ratios, and you can see down here for, let's say, the last 10 years, Apple traded for a range of maybe an average of 15, and then traded way up into the 40s, 45, somewhere in this range. And now it's back down to 25, but it's still overextended. It's still maybe 40% higher than its long-term average, even though we have high levels of inflation. So you're going to get PE compression on all tech stocks that were, allowed a PE expansion during the COVID lockdown. So it's not really a surprise, and now we're shifting towards companies that are making money. Now let's look at some of these other things a little bit more. We have the inflation rate up here, and if I look at the Fed funds rate, I'm going to take inflation off here and just look at the Fed funds rate, because that's the way the Federal Reserve combats inflation. If I look, there's not much of a correlation between the Fed's fund rate and inflation. But if I take inflation off and I put the Fed funds rate and the 2-year Treasury on, what you'll see is a pretty close lockstep between the Fed funds rate, which is the purple line, and the 2-year Treasury rate. So they move pretty closely together. But if you notice, when we start getting inflation, if the Fed funds rate is right on top of the 2-year Treasury, that is deflationary. Okay, I'm going to put on the U.S. recessions here. So here's a chart where the recessions are coming in. We had inflation coming up, and we raised the Fed funds rate above that 2-year rate, and so we are trying to create deflationary pressures on the economy, which we did, which caused the interest rates to come down. And this happened again and again. We did it back here in 2020. But if you notice, something happens here in this chart. There is a huge gap, a bigger gap than we've seen basically in this entire chart between the 2-year rate and the Fed funds rate. And just yesterday, the Fed funds rate was down here at 25 basis points. So they raised it up 50 bips and they are still almost 200 basis points behind the curve. That means they could raise it 50 basis points, 50 basis points, 50 basis points, and they would still be behind. This is an inflationary pressure that's happening to the system. And the numbers that came in today or yesterday were productivity was down. And labor forces and labor pressures were up, so that is also inflationary. So as long as the Fed remains behind the curve, which they are extremely, they are going to be inflationary pressures. So I'm going to take the Fed funds rate out and put on the 10-year. So here's the 2 and the 10-year Treasury rate. As you can see, again, when they start working together and they're crossing over, you get inflation, or you get, a recession often right after that. And I know this chart is pretty hard to see, so the difference between the 2 and 10, I'm going to put that number up here on this is the 2 10-year spread. So this is the difference between the 2 and 10-year spread. So whenever this difference is below 0, that's an inverted yield curve. And as we can see, here's 0 on our chart, and we got an inverted yield curve and then a recession. We got an inverted yield curve and then a recession. Inverted yield curve, then a recession. We had an inverted yield curve, and now the Fed is going to be raising this rates up for over the next year. Are we going to get a more deeply inverted yield curve? I don't know, but there is a good chance for a recession. So what do we think is going to happen? Well, let's go to some charts here. I'm going to show you, right now we have the S&P 500 index up here. I'm looking at the chart. These are just some momentum charts if we want to look at. These are long-term indicators. This is a 10-year chart. Every candlestick is 1 month. If we see that it broke down through the 10-month moving average, the MACD fell, and then the stochastic actually broke through its indicator back here. These are sell signals right now. So that's why we started reducing equity. We didn't reduce equity a lot in the S&P 500 because we weren't seeing the sell signals really that prominently, but we definitely saw them. I'm going to look at, here's a small cap chart. We took action back in January on small cap. We took action back in January on mid cap. Here's the value chart, which again looks a lot like the S&P 500, but here's a growth chart. So we got out of a lot of growth techie names back in January because of this momentum chart, and momentum tends to work. We've been out of bonds for a long time. Look at that awful chart. Out of bonds. As interest rates go up, bonds go down. It broke through this channel and came out of this. That's a bad sign, so we got out of bonds. There is not a good asset class right now that's international. That looks awful. We've been out of those for a long time. Emerging markets, we've been out of that. Tips, you're going to see that. Same thing, out of this for a while. Mortgage-backed securities, let's say MBB, I think it is. Mortgage-backed securities. So these are all asset classes that we've been out of, and we've gotten in some commodities. Look at that chart. We were in commodities, so there are places to hide. Now, you don't want to put all of your money in commodities, obviously. XRE, I think. So you don't want to put all your money in commodities. USC. But that just tells you that there are pockets where you can actually be making some money. So what are we doing from here? Well, we think the weakness is going to continue. I don't foresee us catching up with the curve anytime soon. I see here, I'm going to put up back the S&P 500. If I were to draw a trend line, let's just draw a trend line through the S&P 500. We're starting way back here 10 years ago. And if I look at this trend, it looks like it follows a pretty nice trend for the last 8 years. There's COVID, okay? Right in here is COVID, but it's on a particular line through here, and then after COVID, it takes a leg up. But that leg up seems to be artificial, in my opinion, because of all the federal stimulus, and now that we're going to be backing off the stimulus. So if I were to just draw a line through the S&P 500 and say, hey, well, the SPY is at call it 410, and a mean regression would be at 360, there could be another 50 points to fall. That's, I don't know, 10, 15%, 10, 12%. So will it fall by 10 or 12% more from here? I don't know that for sure, but there is a good realistic opportunity that it could do that. It's not out of the realm of possibility. So we've reduced our equity exposure. We think it's going to be weak and at very little volatile for the foreseeable future. We are placing strategic bets in different sectors and different pockets of the of asset classes and on the investment landscape. But for the most part, we are kind of staying out of the game. I'm looking outside. It's rainy right now. It's cloudy. My analogy is, I can play volleyball when it's sunny out, and I'm pretty sure I'm going to have a good day. If I go outside and it's cloudy, it might rain. I might get struck by lightning. I don't know. I might have a good day. But there's much more risk to the downside than there is risk that it's going to go crazy up. Okay? So that's where we're at right now. We think it's going to be pretty volatile and pretty dark right now. So we are taking moves for your portfolio, buying long-term structured notes with downside protection, 30% downside protection, putting you into areas that may have some hedge on inflation like commodities. Even real estate looks kind of bad right now, but there are sectors of real estate that look good. So that's what we're doing. This is Stuart Cruz with Cruz Asset Management, giving you kind of a inflection point May 6th update. And if you like this video, there are other videos on YouTube. Feel free to subscribe, and don't forget to invest with the odds in your favor.